Imagine turning $100 into $1,000 in, I don't know, in an hour or overnight with minimal risk. While most traders bleed out on high-stake bets, today I'm going to reveal the ultimate zero DTE strategy. It's an out-of-the-money butterfly that delivers explosive convexity. Now this is by slashing drawdowns, boosting your Sharpe ratio, and flipping the odds in your favor. So stay tuned. This is your ticket to elite trading profits without the gamble. So welcome to the final hour show. In a market where most traders chase fleeting wins and suffer crushing losses, imagine a strategy that flips the script. An out-of-the-money butterfly on 0 days to expiration options. This convexity tail risk approach delivers asymmetric rewards with minimal drawdowns, sky-high Sharpe ratios, and elite returns per unit of risk. I'll explain all that very soon, as soon as I take a drink. So this makes it the fastest or safest, most profitable path to consistent gains. So we're going to dive deep into and prove why this is your edge over the crowd, the rest of the way people are doing it. At the heart of our convexity tail risk trading is the mainstay zero DTE strategy. Now that's an out-of-the-money butterfly. Now I know that most of you have been trading butterflies right at the money and probably wondering, well, why would I do that? Well, we'll show you why. And doing it on the 0 days to expiration options. So we can do this on SPX, the S&P index, or the NDX, which is the NASDAQ index. We can also do it on futures, like the E-mini S&P futures, the ES, or the NQ. We can even do it on oil, like the CL. So there's a wide range of things that we can do. I like oil in particular, but it has some weird things about when it actually expires, but the volatility on it is fantastic. And volatility, we are volatility hounds here. In fact, our type of trading is unlike probably anything that you've ever seen. Where most people are running away from volatility, we're running into the fire. That's an important point. So we also do that by offering extreme asymmetry with capped risk. And that's another very important point. And that results in very low drawdowns and a high Sharpe ratio via rapid convexity in tail events. Now, I keep on saying convexity, and you're wondering, what the hell is he talking about? What is this convexity stuff? So we do it for short-term as well as longer-dated options. I'm going to get to the convexity thing in a bit. So we have the zero DTE. That's our mainstay strategy. But we also trade longer dated, like up to 3 to 5 DTE or 5 to 10 DTE. We call those the convex stack. That builds kind of a layered convex bets across multiple expirations for sustained edge accumulation. And then there's the slightly longer one we call Sigma drift, and that exploits volatility drifts in extended horizons for trend-enhanced convexity. There's that term again, convexity. By the end of this video, you're going to not only know what convexity means, but you're going to learn to love it and dream about it. So our strategies go from basically the defined by time frame. Zero DTE is on 1 day, and we do have, I guess you could call them edge cases that could go out to 1 or 2 days with zero DTE. Of course, it's no longer zero DTE, but we'll show you why. And then the longer dated ones, Convex and Sigma. They all leverage convexity for asymmetric rewards. Now, I know you know what asymmetric is. Asymmetric is anything where you're taking something small and in return you get something big. The benefit of that is that it's minimizing the amount of risk that you're putting up. And it targets tail profits that not a huge win rate, probably around 50% of the win rates, but the profits that you get so outdo the fact that it's a lower win rate that you'll never notice. So the difference is that 0DTE focuses on intraday speed and immediacy. It's a little bit more hands-on too, where the longer dated ones you can sort of sit back and just peer in on it every once in a while. That's a huge benefit. Here, let me just see if I can get the comments out here, just in case any of you have any comments. I'll address them as soon as I can. So the shorter the time frame, the more focus that you have on the trade. So if you like day trading, 0DTE is right there for you. But we don't take a lot of trades. It's not like you're taking trade after trade after trade and relying on your frequency in order to get your success. I mean, that's basically how a momentum trader works, and they'll just keep at it until they either give up or they have a positive day, and that's extremely stressful. We don't do that at all. So the convex stack, though, emphasizes multi-layer compounding, and so what that means is you're taking longer dated options, say 3 to 5 days, and then sort of overlapping them one after the other, kind of rolling them, but you roll them before the previous one has expired. And so you're creating kind of a rolling window and tent across a wide range of prices that makes it rather easy to capture profits. So the Sigma drift, though, integrates these drift trends for directional bias in volatility plays. Essentially, you're putting on these super wide flies, and you put them out 5 to 10 days, and you do that on a regular basis. Now, what happens with markets is that most of the time they're moving within the expected move. And the market is pricing all of your options for that expected move. So it's like a range. The truth, though, is that the market is underpricing that expected move about 20% of the time. So about 20% of the time, it exceeds the expected move, but not just by a little. The average amount that it can go above that is sometimes 2-3 times the expected move. And that's where we're playing. We're playing on the other side of expected move, and that is actually where convexity is, on the other side of the expected move. It's actually the place where most of the market is kind of saying, well, that's not really worth it for me to play because it's not going to give me my high win rate, and I am looking for that tiny little profit that I can get regularly. So they underprice it, and we pick that up. What they're not betting on is all those big moves that they're sitting there just salivating, wish they could have been in, because they can't, because they're only after, get something in my eye, they're after those small wins. We're the guys that are making those big wins. So you say, man, I wish I was in that trade. That's the trade we're in. And they're the ones that make the big money. So the 0DTE strategy is definitely our mainstay, though. It can be used across any volatility regime. So it doesn't matter if volatility is super low, or what we call the Goldilocks zone, or if it's in chaos. Doesn't matter. We can play this trade. In fact, the strategy itself gets a lot stronger as volatility goes up. And when volatility drops, then the risk actually gets higher, so we reduce our exposure to it. But then we have other trades that will take that up. That's really where the longer dated trades come in. So if you go back to yesterday's broadcast, you'll learn all about that expansion and contraction of volatility and how that affects premium decay. So just go to that. Go back to watch yesterday's episode where we covered volatility and premium decay in great detail. So our 0DTE strategy also has edge cases. So while you can play, super low volatility, the sweet spot, or high volatility, there are other strategies that we can employ that make it a little bit more tasty. So when volatility is super high, or when it's in the basement. So what we're talking about when it's super high, we tend to play both sides of the market in a strategy that we call the Batman. Now the Batman is simply putting a butterfly on either side of the market. And the reason why we call it the Batman is because it looks like Batman's ears. And then the strategy we use when volatility is very low is called time warp. That is the reason why we call it time warp is that, and again, I implore you to go and look at yesterday's broadcast, because we talk about how in low volatility, premium decay is accelerated. So sometimes all of that premium that you want to collect actually happened the day before or the day before that. And so by extending our trade out like that, we capture that premium. Also, in super low volatility, have you ever noticed that price tends to move a lot in the overnight market in really, really low volatility, and you feel like you missed the move when you're there ready to trade? That's what time warp is. It goes back in time, captures those overnight moves and the accelerated premium. So those are our edge cases. But for today, we're going to stick to the standard 0 DTE out of the money butterfly and also our gamma scalp trade. And actually, as we go further into this this whole series, we're going to start taking trades when they present themselves, the gamma scalp trade, right at this time frame in this 3 to 4 p.m. window, and that will be our gamma scalp trade. So you should stick to this, hang out here, wait for us to make that trade, because it's going to be your opportunity to make some serious cash. And we'll also look at what makes all of these things work. Convexity. So now I'm going to talk about what convexity actually is. So what is convexity? In trading, convexity refers to the nonlinear payoff structure where profits accelerate faster than losses. They create extreme asymmetry in a risk-to-reward ratio. In reality, what that means is that if you're putting on a strategy, imagine this, you put on an out-of-the-money butterfly, and then you have your max profit and your debit, you see it. And you'll note that if you take that butterfly and move it a little bit further away from the market, then the debit goes down. And the further you move it away, the more the debit goes down. Now, the rate at which that debit goes down will seem kind of linear. You know, every 5 points it goes down. Every 5 points out you put it, or one strikeout, it goes down maybe 10 cents, and then another 10 cents, then another 10 cents. Then you notice you get to one point where all of a sudden, instead of going down 10 cents, it goes down like 40 cents. That change in the rate of prices or premiums or whatever, that is where convexity lives. That's where the market is deciding, we're losing interest. We're not going to trade here. That's exactly where we trade, because that means that that's the point on an expected move where everybody else is underpricing those options. And so we step right in and say, thank you very much. We'll take that. And now, for something that isn't much materially different than a trade that they would normally take, we're only maybe 1 or 2 strikes out of the money. We have a strategy that costs 30, 40, 50% less. So now when price comes towards us, sure, they may make money in that trade, but we actually make a lot more money, and we make it sooner, and it costs us less money. That's what convexity is. We find it in out-of-the-money butterflies on 0 DT options by scanning for these far-out strikes with undervalued premiums that surge during tail events or volatility spikes. It exists due to market inefficiencies, such as fear-driven underpricing of tails, and also rapid theta decay in 0 DTE, and imbalances in supply and demand for protection. Now, what's the real benefit to grabbing convexity? So while most traders are chasing linear strategies, needing a much higher win rate in order to make anything and stay away from that risk, which is not possible because risk is inevitable, and they suffer huge drawdowns. Trading this way keeps us away from those big losses. Our losses are always tiny, really tiny. So we have small drawdowns and real tight volatility in our equity curves. So in other words, our equity curves aren't going like this. They're not doing this. They're doing this, right? So at a minimal, we're looking for risk to reward ratios of like 1 to 10. So 1 part risk to 10 parts reward. That's our minimal per unit risk. And that results in, like I said, low drawdowns. And now when I say low drawdowns, it's not unusual for retail traders to take 20, 30, even 50% drawdowns. And I'm sure that you've also experienced the 80 or even 100% drawdown. That never happens with us. Our drawdowns never get down below 5 or 6%. On average, they usually stay within 1 or 2% because our bets are so small that that doesn't happen. But when we win, we advance our account. So what that means is that our account is typically going sideways like this, then up, sideways, then up, sideways, then up. And so that behavior of your equity is what allows you to compound over time. So we're turning these small bets into outsized rewards safely, often unknown to most of you retail traders. So what are the structural benefits? See, convexity tail risk trading with out-of-the-money butterflies, 0 DTE out-of-the-money butterflies, yields, like I said, low drawdowns, minimal peak to trough losses, tight equity curve, nice and stable performance, and high Sharpe ratios. That's superior risk-adjusted returns. So that means that I take small risk, I get big wins, where everybody else is taking huge risk and getting small returns. Which way would you rather trade? And it's desirable because it quantifies efficiency. Higher value means better rewards for risk taken, favoring consistent, low volatility strategies over erratic ones. I mean, an iron condor at 0 DTE is one of the most erratic strategies I could ever think of. You're putting on these maybe 10 wide, maybe 10 delta trades, and you think that you're putting on something that has 90% risk, yet your trade has $1,000 worth of risk and you're going after max $100 of profit. And your strategy, you don't even go for that $100 of profit, because once it gets to $50, you take it real quick. Because you know that if the market starts going left or right, you're going to be getting closer to that risk event, and your losses, your unrealized losses, start mounting up very, very quickly. That's why they have on these strategies stops. Of course, most people don't play the stops because they feel like it's going to come back. They say, hey, it's a 90% trade. I should make money on this. And then they end up losing. On what should be a 90% win rate trade. And they don't do it because the risk and the fear that comes from being in a trade like that, the gamma that you experience, is just too much to bear. And also when you put the stop on, you're effectively bringing in the risk limits. And when you do that, you're turning your 90% trade into about a 60% win rate trade, right? So now you're going and trading at a 60% win rate with much less risk, or with much less profit, where we're taking approximately that same win rate with up to 20 to 30 times more profit. Think about that. Your high win rate strategy is giving you way more risk. You're purposefully putting on stops that reduce the win rate to a much smaller win rate and going after much smaller profit, where we never experience that risk because our risk is limited to a very small amount, yet we're always going after that big profit. Like, duh, right? And so what are some of the psychological benefits of trading this way? Well, I would say, first of all, the psychological non-benefit, the thing that you need to get over, which doesn't take very long, is the idea of not winning all, with a higher win rate. That you can go through streaks of losses, 4, 5, 6 losses in a row, but they're so small that it doesn't matter. Right? That's the main psychological detriment to this, but there are huge benefits to it as well. Because it's going to eliminate your blow-up fears. You know that you're never going to blow up. It's capping your risk. It ensures you're always in the game via small asymmetric bets. Near zero risk of ruin. So for instance, on our 0DTE trade, if you're trading, let's say, SPX, and you want to figure out, well, if I put this much money in, what are the odds are that I'm going to bust my account? There is odds that you could, bust the account if you're in that and you have a series of losses and just run into just super bad luck over and over and over again. So I've done a study where it shows that your odds, if you have a $1,000 account and you're trading this, the odds are about 35% that you're going to bust the account. You go to $2,000, those odds go down to about 15%. You go to $3,000, those odds go down to about 5%. You go to $4,000, now your odds go down to maybe sub 1%. And anything over that, it's virtually zero. So that's the real benefit. You're near zero risk of ruin probability, and that fosters calm, disciplined trading. When you're in that kind of mindset, it's super easy to be a player in this game because you know that your risk of ruin is virtually zero, that you're going to stay in the game, you're just waiting for those big wins and it's going to move you up. And as long as you play that game, that's where your trajectory is going to be. In that kind of environment, you can always be making calm, rational, logical decisions in your profit management. And that's the other big thing, is that I know a retail trader, their number one deal is how to manage risk, and everybody does it very poorly. It's the number one reason why most people lose, because dealing with heavy-duty risk management is really tough on the head, right? We don't deal with that at all, right? That risk management is the downfall of most people, and they tell you that you need to somehow get a hold of your emotions, right? Or go into your trading and being stoic. You can't just get rid of your emotions. They happen even if you're in a spot where you have very tiny risk. Your emotions can get the better of you. But at least with the tiny risk, your emotions won't hurt you. In your current situation, your emotions are the detriment to you. Those are the things that are going to send you apoplectic. Those are the things that are going to force you to trade out of fear or try to revenge trade or experience FOMO when you miss a trade or overtrade, right? And all of those things, all they do is add more risk. And it's just a big spiral. You right down. Where are we? Oh, we're halfway into this. All right. So trading our way reduces that fear component, that anxiety down to very little to nothing. It fosters calm, disciplined trading. All right. Now, what we're going to do is take a look at a trade that I have on currently, and it's a gamma scalp. And I'm going to explain what a gamma scalp is. And this is a trade that we're going to try to do every day, probably right around this time from 3:30 on or 3:25 on. And this is like the perfect time to do it. And it's a pretty interesting trade. what we're trying to do is we're trying to take advantage of the gamma that's built up in our butterfly trade and juxtapose that or position that to a structural level. In other words, support or resistance. All right, so let's first take a look at the volume profile, and I'll show you where that support or resistance is. So I just need to change this a bit, and hold on. Almost there. Come on. There we go. I think I have to make this a little bit darker so you can see it. Yeah, that's better. I know, you're wondering, where the hell is it? Here it comes. All right, I don't know what's going to happen when I push this button. Nope. All right, there it is. All right, so we're in the E-mini S&P futures. I'm actually trading this in the SPX. So maybe we can go over here and take a look at it. Yeah, this is more fun here. So it's just a different view. I'm going to expand it so that we can see this really, really cleanly. And there we go. Get rid of all the other noise. So this would have been one of our trades this morning, a 0 DTE trade, where it comes down to a structural level, this green level. And I called this out before the beforehand, and take a trade here and then ride it all the way up. All right, so once we get up here, there is another structural level right here. And we can take a better look at that if I zoom out. Do maybe an hour chart. Yeah, that'd be good. Let's see. Come on, volume profile. So I'm going to make this nice and light so it's easy to see. There we go. And we'll bring in even more there. Oh, that's perfect. Okay. And I don't think we need this guy right here. We'll take that out of the way. All right. And just to make this a little bit easier, we'll leave an add in the SPX. SPX, indexes, and new price scale. And so there it is in red. I'm going to make it a different color. Let's make it, I don't know, like a grayish color, like that. That looks nice. Okay, so we have the volume profile. Oh, by the way, the pricing over here, the one that's on the very outside, that's the SPX price. And then on the inside is the E-mini S&P futures price. So I can see them right next to each other very easily. All right, and then I can see exactly where the SPX is based on price here. All right. So the reason why it looks like mostly straight lines is that that's the overnight action. So wherever you see a straight line, that was, and you see on the E-mini not straight lines, that's where the E-mini's trading. And then the straight line is the overnight action where the SPX isn't trading. So we'll get to that in a second. So I'll hide it for now, just so that won't be confusing. All right. So what we do is we take a look at the volume profile. And volume profile is the price at, or the volume at very specific volume levels. And one thing that when you start looking at volume profile, you start noticing that the market likes certain levels and it trades a lot there. And then it creates these nodes where the market has found value. And you can see they're very well defined. Like here, I'll use my my rectangle tool to point something out. Like here's a nice node right there. All right. Here's another nice node down here. Right there. And then there's another one way up here. And then there's a smaller one right here. That's the one that's of interest right now. The reason why it's of interest, you'll see I put this thick yellow line right at the top of that node. Here, I'll hide all the lines so you can see it. See, this node right here is where price is trying to break out from the top of this node. It found relative comfort right here, and now it's going into an area of low liquidity. Now, when price goes into low liquidity, it tends to move fast. And you can tell that by looking at previous action going through that low liquidity zone, what I call a volume well. Some people call that a low value node. And price moved very quickly through there, way up here. That's a big move. Bam! And then when it came down below it, it moved down quickly and then back up quickly. And then when it came down through here, down quickly. Now, we're sitting here right at the edge, half hour to go. What are we going to do? Are we going to move up into here very quickly or not? If we do, we're going to make buco bucks because we put a fly right above it right here. All right? So now let me show you what that looks like in trading time, because this is an hour chart, and so I want to go down to a 5-minute chart. And we'll zoom in on it and then add the lines back. So this is that big, thick yellow line you saw at the top of that node. Now that we're zoomed in, we actually don't need the volume profile anymore. We can see it. We're getting a breakout right now. See it? It's breaking. It's going into that low liquidity area, and hopefully it'll get some steam and move further up. Now I have a butterfly right up there. Let's see. And my butterfly is on another platform. And I don't have it here to show you. Let's see here. Maybe I can take a screenshot of it and bring it over. All right, I just took a screenshot of it. I'm going to see if I can move it over. I'll send it over to me. And then we'll take a look at it, and you'll see how it's positioned and how small the risk is and how big the potential profit is. That's what's going to blow your mind. Let's see. There it is. All right, I sent it over. All right. Not showing it yet, but we'll show it now. No, that's not it. Oh, that's why. I have to open this with preview. There it is. Let's get rid of this picture of Uncle Ernie. All right. So there it is. There's the butterfly. You can see I paid 80 cents for it, which is $80. It has a max reward. Now this is a 30 wide butterfly. All right. So what's the max reward on something like this? The max reward of a butterfly is the width minus the debit. So that's 30 minus 0.8. That means it's 29.2, or times 100, that's $2,920 for an $80 bet. Now divided by 0.8, that makes it a 1 to 36.5 risk to reward ratio. Now that's the cool part. Now it's not moving right now because this is just a picture. All right, let's take that off and go back to Trading View. So that's what we're waiting for. We're waiting. Okay, it started to break out. Now it's pulled back a little bit. We still have 24 minutes to go. So if it starts breaking up here, once it hits this level here, we're starting to make pretty good profit. If it gets beyond there, then it'll make, you know, exceptional profit. I've had trades like this where I've been in them for as little as 5 minutes and made several $100s, or been in it for maybe a little bit longer and made $1,200, $1,300, $1,400, just with a little move like that. So the principle behind this is that we take the gamma that is present in our strategy. Let's see, I'm going to open this up with preview. And show you that again. So what is gamma? Gamma is the sensitivity to price. So when you look at your P&L on this, gamma is really the steepness of this purple line here, right? And you can see that that means that its sensitivity to price is extremely high. That means it has high gamma. So when price interacts with it, the value goes up very quickly, and it doesn't have to move very far. So from here, 10 points into here would end up making it a $500 trade. If it moves another 10 points, now we're talking about nearly a $1,500 trade, right? And if it moves a little bit more, it could be as much as $2,900. So that's the play that we're making, and we position it the trade, remember, right on that structural level. So we'll zoom out again so you can see that structural level. That doesn't look so good, does it? Bring in the volume profile. And that structural level is from this node where there's liquidity into this area where there's very little liquidity. And so what we're planning on here is if it can catch a spark, like it did many times before, move through it very quickly. So you can see like this move right here, one candle, it moved up from 63.77 all the way up to 63, let's see, it moved as high as 63.93. All right, so about 17 points or so. That 17 points would result in about a $500 trade. So if it can move up here, that's what we'll experience. If it can move all the way to this other node, now we're talking about a $1,500 plus trade. So that's our play. Now, I played this a little early, so it's not on there in an optimal way. I might have played a narrower fly and tried to get it even closer. It would have been reduced profit, but it would have been closer and more sensitive to the price movement. But this was something I had to set up before we got here. When we do this in the future, we'll be setting these up dynamically and trying to put on the the maximum value. Now, the great part about this is that I don't have to win very often. I put up $80 to win potentially $500, $1,500. A $1,500 trade is not out of the question. So $80 divided by 1,500, right? Let's see. I'm sorry, that's 1,500 minus 80 divided by 80. That's a 1,700% risk reward. So that's the type of reward we're going for in these gamma scalps. Now, some of them, most of them will probably make 3, 4, 5 times your risk. Some of them can make, like I said, 15, 20 times your risk. You'll probably end up losing about half of them. And that's not really a bad thing because the risk is super small. All right, let's see here. Oh, we got lots of questions. Let's see, Dan is asking, what time of day do you feel is the best for putting these on? You want to put it on when the premium has mostly decayed in a butterfly. That'll do 2 things for you. One is it will allow you to bring the butterfly much closer to your structural level, and it will cost less, and the gamma curve or the gamma will be much steeper. So that means that there's a better chance of making money. And what we're really hoping for on that last half hour, 45 minutes, is one of those sharp moves that you often see near the end of the day. And that probably happens about half the time. So that's what we're looking for. All right. Jared says, I'd like to see that study on probability of account bust. I know the same thing can be said about high probability trades, the probability of having a series of losses on trading taking on 5% risk. Yeah, I will put that together for a future show. I don't have it available to me right now, but it's pretty cool. The fact is, I showed this yesterday, the difference in the distribution of returns for a high probability strategy ends up giving you a negatively skewed distribution or left skewed probability or distribution of returns, where the type of trading that we're doing has capped risk and much larger potential going up. So it has a right skewed positive skew on the distribution of returns. The high win rate is not scalable. The low win rate is scalable. So that's the big change. But I'll show you the risk of ruin study that I did. Is higher risk to reward considered an edge? Higher risk to no, I would not say, not higher risk to reward, because higher risk, if you're taking 10 times the amount of risk as you get for reward, I don't know how that's an edge. You might have a higher win rate, but your risk is inevitable. You're going to encounter it. Everybody in trading does, right? Everybody does, and that's why they lose. All right. Jared's continuing on. That is, a series of 20 losses in a row is basically one in infinity. Yeah. If the probability of each trade is 1 to 10, 90%. No, that's not true. How many times have you been in a trade that has a, let's see, if the probability of each trade is 90% win rate. Yeah, I've been in 90% win rate trades. Now, as I described, most of these trades don't end up being 90% because you have typically a cutoff or a stop that actually reduces that profitable window that you're compelled to get out because the risk is too high of going to a maximal loss. So those 90% win rate trades never end up being 90%. First of all, that's the big thing. So then your whole risk to reward ratio goes right out the window. Oh, Jared is asking a lot of questions here. So I think this approach is the other side of the same coin. No, it's not. This is the way pros trade, Jared. This is the way I traded as a institutional trader. This is the way every pro trader I know trades, trading convexity, right? Have you ever gone to the options chain and gone out there way, way far out and looked at open interest, and it's like 200, 300, 400 points out there, and there's like 15,000 contracts out there, and you wonder why? Well, that's the pros trading this strategy. They know that that they're positioned out there. They're going to eventually hit that or come near it, and it's going to pay off big. In the meantime, it costs them very little for that insurance. Those are kind of extreme examples, but let's see. Vickery. How does trading a simulated trade on toss to real-time trades? Is it a good trading tool, or is the result misleading? Well, you know, you can put on a simulated trade and you can see what the price action and where, whether you're in profit or not, that sort of thing. But if you're sitting there trying to figure out whether or not your performance when you're actually executing to get in or get out is representative of a real thing, it's not. That's because the platform is giving you very optimistic fills. So it will always seem better than it actually is. So it is misleading. You're just as well off just to put it in analytical mode and then note where price is, where you would have gotten in, where you would have gotten out. Of course, you have to be a little bit more realistic when you're notating that. But simulated trading does not show you whether or not you're going to win, particularly if you're cutting it close to the edge, as most people do in high win rate strategies. It's a bit better when you're doing simulated trading in this type of thing because it's sort of undeniable when you're in profit here and the risk is so small. Even if you're sloppy in getting in and getting out, you're much better off. The return will, versus the mistakes will be much better. And so, Jared, I agree. Paper trading is misleading, both emotionally and technically. You get these really good-looking fills. All right, Jared has that trade. Jared is a chatterbox today. Thank you very much, by the way. Yes, the gamma curve is flatter earlier in the day. That's why I've suggested that we take this trade in the final hour show when gamma is much higher and premium has already done most of its decaying. Let's see, Bill, when, time, and at what price level did you put the gamma trade you have on? Well, I put it on before the show, but normally I probably would have waited until right about now, or around 3:30. So I did definitely put it on earlier than I normally would have put it on. So price has retracted, by the way, so far. So it looks like this trade's going to be a bust. That's too bad. Lincoln Log, do you have the 6390 30 wide fly on? Yeah, I believe that's what it is. Hold on, let me check. Yes, 6390 30 wide, 80 cents. JT True, do you use the same type of profit management framework for gamma scalping as you do with the regular 0DTE? Well, it's not exactly the same because, first of all, with the 0DTE trade, we're really playing a different time clock, right? With the scalping trade, you're more opportunistic, and particularly because the gamma is much higher, the sensitivity to price is much higher, so you have to make quicker decisions. With the 0DTE trade, your gamma is super low in the morning, and when you're in a profitable situation, you have more time to react, and also because you're early in the morning, there's more volatility, so you can typically give yourself a much wider zone of tolerance. So that's how it would basically differ. All right. So we're at 10 minutes before the hour, and it looks like the trade is like the market is retracting. Let's see. Let's go back there. Yeah, it's tough getting up into this low liquidity area. Sometimes it just doesn't want to get up there, no matter what, how much you hope. So, yeah, we pushed up there and got soundly rejected. Now, there's still 10 minutes left and anything can happen. But my bet is that we're probably done for this trade. So it was a good shot, It was like teetering on the edge and then just pulled back. I put on a very similar trade back in June. Let's see here. Let's see if I can bring that up. It's in my trade log. I'll show you what it looked like. And that's that one. Hold on a sec. I'll bring it up. Microsoft Excel. So actually it was in July, early July. And so it was 20 wide. Now, I usually don't trade 20 wide. That's how I can tell that this is the gamma scalp, because I put on a 20 wide, put it very close to the structural level. I took 4 contracts, and I entered at 70 cents and exited at $4. I think I was in this trade for about 5 minutes and made $1,284. So that's a typical gamma scalp. Other gamma scalps that I've put on here. This was another one right here. Mid-July. Right? 30 wide, three contracts. That's usually how I can tell it was a gamma scalp, because I put a bunch of contracts on. I was very close to the money, made $3. So I made almost $900 on that one. And then the last one that I did was this a gamma scalp? I'm pretty sure it was. Yeah. This one here, just last week. Again, 20 wide, put 4 contracts on. This one didn't move quite as much, but I paid a lot less. Made $1.55, $384. So there's 3 gamma scalp trades for you. The rest of these trades are extreme risk to reward, way out of the money. Now, see, this is the type of thing that you have to put up with this type of trading, a bunch of small losses. All right? And you can have clusters of them. However, the proof is in the pudding, and that is the performance. And that is extremely low drawdown, never went down below. Now, this is only a month's worth of trading, or 40 days worth of trading. 35 trades. Profit factor of 3. Win rate right around 50%. Drawdown super low. Extremely high Sharpe ratio, indicating that my profit was very high per unit of risk. And my average risk to reward was just outrageous, 1 to 43. Right? So even on my 0 DTE trades, I'm putting them really far out there. Most of them I'm going to lose. There's no doubt. But when I win, I get multiples of my risk. So this was working in an account that was 85,000. So for 1 month, I made a little over a month, I made 5.37%. If you extend that out over the course of a year, you'd make about 60% on your account if you traded at the same level. I generally, on accounts that size, average somewhere between 4 and 7% per month, and with super low risk, right? I know that you're probably looking at some guys that are doing momentum trading and trading penny stocks, and they're claiming that they're making thousands of percent per month or whatever. That's great, except that they also lose thousands of percent, and their returns are all over the place. There are some exceptions, but this is a low risk way of trading, very easy to handle psychologically, and over the long term, you're going to find that this is the best way to compound your account. All right, let's go back to the big head. We're just about out of time. Let's see, I just want to take one more look. Nope, that trade's gone. Oh well. All right, that's it. Hope that this episode was useful. We talked about risk to reward, how it's important to take on asymmetric positions, what is convexity, how we use it, and then you got an introduction to our gamma scalping trade, which will be a mainstay here. We'll try to do one of these every time we do the show, right? And can't promise that they're all going to be winners, but when they are winners, they're going to be big. And when they're not, they're going to be very, very tiny. That's all I've got to say. Thank you very much for hanging on in here. This is Coach Ernie, and I am out.